Hi folks. When it comes to investing, we often take the rate of return or the rate of possible return as the most important metric. We ignore other parameters which may ultimately result in us making a poor investment. Let me give you an example. Let's say that I have to generate rupees 10,000 in 1 month's time. I have two choices. One is the bank FD, which is giving me 7%, and the other is an instrument X, which can give me 12% return. To generate 10,000 rupees, I have to put 17 lakhs into an FD. And if that gives me 7% for the year, that means it'll give me 10,000 rupees in 1 month's time. Comparatively, I have to put 10 lakh rupees into the other instrument, which is giving me 12% per annum. The difference between 10 lakh and 17 lakhs is obviously large. But practically, how many of us can actually invest this kind of amount frequently? We may be able to put a few thousands or 1 or 2 lakhs. So, taking 1 lakh as an example, what is the output that I get in a month? In a fixed deposit, which is giving me 7%, I get 600 rupees. In an instrument which is giving me 12% per annum, I'm getting 1000 rupees. Again, the percentage difference seems large. I'm getting 65% more in instrument X. However, when there is an instrument which promises you higher returns, it is typically accompanied by volatility. I'll give you an example. The net asset value or NAV of HDFC Gold ETF on 18 July 2024 was rupees 64.88. If I had invested 1 lakh, then I would have got 1542 units. As on 25th July 2024, the NAV has dropped to 61.9 rupees. That means the current value of the amount I invested has dropped from 1 lakh to rupees 95,407. By chasing a gain of 400 rupees, not only have I lost that gain which I could have made, I've also entered into a potentially loss making situation. But you can see how volatility has caused my strategy to go bad. So it is important that when we enter into an investment which has volatility, we give it time to ride out the volatility. This behavior has been exhibited in the past in gold, property, or in mutual funds. Of course, past returns do not guarantee future returns, so we have to take that aspect into consideration. Now, in this example, I have shown the returns that can come from investing 1 lakh into an instrument which is giving 7% year on year for the next 10 years and into an instrument which is giving 12% year on year. You can see that while the amounts of 7% and 12% don't sound very high, but by giving it time and letting the returns compound, the end result is quite different. In the instrument that is generating 12%, you have earned significantly higher returns. So, in conclusion, 2 points to keep in mind is that save more and invest larger amounts so that your absolute returns, which is the quantum of returns, are actually larger. The second point is to study the investment avenues closely, understand the returns as well as the risks involved, give instruments time to ride out volatility, to ride out risk elements, and then take a decision on investing in the instrument which suits you the most. So I hope this video helped you to understand the concept of returns in different aspects. If you have any queries, please do drop a comment and we'll be happy to get back to you. Thanks for watching.